How often have you heard some talking head declare that hedge fund speculators are causing a big bubble in commodities? Frankly, it's total nonsense. But it's a frequent explanation for the endless and mystifying price increases in minerals like coal and iron, and things like steel, oil. Maybe there are some hedge funds distorting these markets, but my take, there's just way too much demand for all these commodities worldwide and not enough supply. Where do I get my thesis? Why am I so cocksure about it? I do the homework. I listen to calls. I read analyst reports. And I read press releases like the one that I read this morning from Joy Global, okay? And others just like it. I want you to take a look at the fabulous quarterly earnings release this morning from Joy Global, which is the leading maker of underground and surface mining equipment. This is what I call a new technology company solving mankind's problems. I recommended it on March 1st for a 2.2% gain so far. Joy Global raised guidance today from 296 to 322 to 315 to 330. That means they raised the range. Why? Because it says every single end market it deals with is in short supply of the machines and infrastructure needed to get at coal and minerals. You think the hedge funds are inflating prices? Just listen to what Joy Global had to say in its release, and I quote, "The company continues to benefit from unprecedented demand for its underground and surface mining equipment in response to the strong demand for coal, copper, iron ore, and oil sands. The gap in coal demand alone could reach 60 to 100 million tons this year." I got to tell you, that's massive. Even the U.S., often thought of as the Saudi Arabia of coal, can't make up that amount. How about steel shortages? Again, caused by hedge funds? Are they hoarding steel in their Wall Street offices? Or could it be, as Joy Global says, both metallurgical coal and iron ore remain in significant decline? And some projections indicate that steel shortage could be 20 to 30 million tons in excess of what can be produced. Copper can't meet the demand either. Why? As emerging markets, particularly China and India, continue to industrialize, their demand for this stuff becomes more and more ravenous. The result for Joy Global is indeed joyous. I see 3 to 5 years of earnings visibility thanks to a 3 to 5 year supply deficit. With the U.S., like Obi-Wan Kenobi, as the only hope of swing production to meet demand, which, of course, means a dramatic increase in the need for the equipment Joy Global makes. I defy you to find me a dozen companies in the world with that kind of earnings visibility. How many can see that clearly now? Let's stop the charade. U.S. interest rates don't control the price of these commodities. Raising rates won't curb inflation. All that would do is make it harder for the companies that need Joy Global's equipment to buy it. The very equipment needed to knock down prices eventually by building inventories. Hedge funds are not behind the shortages. Endless demand and a lack of mining equipment are responsible. If you want to understand this moment, you need to understand Joy Global, not the Fed, not the imaginary hedge fund boogeyman. And that's why we need to speak to Michael Sutherland, the president and CEO of Joy Global, a man who understands these times better than anyone else, and a man that we've been putting our mad money behind for some time. Mr. Sutherland, welcome to Mad Money.
Thank you, Jim. Glad to be here.
Mr. Sutherland, throughout your statements this morning and throughout your conference call, you paint a picture of insatiable worldwide demand. Does it seem like any of that demand to you is coming from hedge fund and financial speculators?
Well, certainly in the commodity-traded metals and minerals, we see investors doing direct investment in commodities, and that does influence the price, but it's not significant. It's not a significant driver of value in the long run. We look at a market like iron ore, which does not have any commodity trades. It's all direct contracts between supplier and consumer, and the prices in iron ore have gone up faster than most other commodities. So there certainly isn't anything that we see in the commodities themselves or in the comparisons between commodities that suggests that the prices are being excessively hyped by speculators. It's all a matter of of supply not able to catch up with the continued growth in demand.
Right. Now, Mr. Sutherland, and one of the points why I talk about your company endlessly on our show is you also make the point that it's not just China and India, right? The demand where you're selling equipment now is quite diverse from where you were selling it 5 years ago, isn't it?
The markets have tremendously diversified. We are in an industry that's moving. 20 years ago, it was an Atlantic Basin industry. Now it's a Pacific Rim industry, and it's rapidly moving to an emerging market industry. So the center of gravity in the industry and the center of consumption of commodities is really being driven by the emerging markets today, and you can see that examples of that around the world as you travel. But it's not China and India alone. I mean, we're seeing infrastructure bills in places like Russia, Indonesia, Turkey, Dubai, Brazil, and you just go around the world, and there's a tremendous amount of infrastructure bills that it's consuming iron and steel and coal and other kind of commodities. So,
do you agree with me with the notion that it's somewhat fatuous to think that if the Federal Reserve would take up rates, that somehow that would produce an inventory build that would bring down prices, given the fact that you need your machines to create that inventory, and you can't make your machines fast enough?
Well, I think that's right. I mean, we don't see the fundamentals in our industry are driven over long cycles. So our customers are spending money on mine expansions today that they expect to come online in 5 to 7 years from now. So the near-term ups and downs don't tremendously influence where they make their long-term investments. It doesn't influence their purchase of our equipment, which is long lead time equipment as well. So we don't think that those kind of near-term adjustments really help. It probably confuses the situation more than it is helpful.
One last question. It's very clear to me, despite the fact that in our country we think that the media thinks and some politicians think that coal is third rail, can't be touched. You're seeing global unprecedented demand for coal being used in power plants, aren't you?
Absolutely. We're seeing we think that 80% of the power plants built over the next 2 decades will be built in the emerging markets, which have pretty ample coal supplies and will use that to generate electricity. We're also seeing coal-fired power plants being built in Europe with more in planning. The reality is that we do not have enough energy supply in any form, coal, natural gas, oil, to satisfy the growing demand for energy around the world. So we can't just arbitrarily dispense with any of it. We've got to get maximum value out of every out of every energy source we have. Coal is one of those primary energy sources that's going to serve baseload power generation, and it's going to do that in the emerging markets. It's going to do that in the mature markets, and it's going to be the only way we're going to keep electricity growing at rates to maintain standards of living.
Thank you, Mike Sutherland, President and CEO of Joy Global, Inc.
Thank you, Jim.
Listen up, people. You got a dramatic increase in earnings today in the estimates. You see long-term demand for the machines that bring out coal and copper and oil shale. That's Joy Global. If the copper stocks, if the coal stocks had been up more today, this stock would have been up 10%. Your opportunity right here in the 80s. Pull the trigger. This company's got great numbers for years and years. After the break, I'll try to make you even more money.